Good afternoon, everyone. Thank you for joining me today. So we're going to be talking about a pretty interesting, fascinating topic. We are going to try and combine both the worlds of traditional finance as well as blockchain tech. For a long time, most of us in this field think of traditional finance or like banks and institutions as the enemy, and blockchain being like a different breed altogether. What I am trying to convey through this presentation is how both these worlds can actually merge together and work in a much more inclusive and better way. So learning from traditional finance. So they have, first of all, they have a super long history. They've been around for over 300, 400 years. Some of these banks have gone through all their reps and they've done all the work. They have compliance, they have regulations, and it's not like they're just operating in one particular space. They've been working across borders. So we've been trying to solve cross-border payments through crypto, but these guys have done it already. So there is quite a bit that we can learn straight from them. They have great developments. For example, the Glass-Steagall Act, which minimizes the risk of financial crises. Now, do they happen? Of course, we have enough and more examples in our world, with 2008 probably being the most prominent, 2020 and just the random printing of money, which went on without any inflation immediately. They have many, many disadvantages. There are entire systemic risks at place, where if one bank collapses, there could be a bank run on the central bank and everything else after. But by integrating blockchain tech with what traditional banks do, we can really change the game, helping improve both those lives. So why exactly is there a need for security in finance? Now, security in banks especially is crucial for many different reasons. First of all, it is your hard-earned money. It could be your pension funds. It could be money you've saved up for retirement, and you want to make sure that it is in a place where it is completely safe. But secondly, there is also the risk of personal identity theft. Your personal IDs have become more and more valuable as times have gone on. You don't really want your data or your personal information out there. And there are major issues as well. Just on 19th April in LA, there was a bank run, and a group of robbers walked into a bank on a holiday and stole over $30 million. So this happened just 1 month ago. So it isn't that they are foolproof, but their entire system, the way they are built, because they can rely on their central banks, they can rely on the SEC, the RBI, with various other firms, they can go to the IMF, they can work with so many other institutions, it just makes them safe regardless. Coming to our favorite topic, I guess this is what everybody's here for. Blockchain tech. I'll just breeze through all of this really quickly, because I'm sure most of us know exactly what's going on here. With blockchain, you have real-time transaction processing, something which banks can't do. Even here in the UAE, where everything is built towards banks, everything is built towards financing, it still takes you ages to add a beneficiary. Not the case when it comes to blockchain. Transparency and decentralization. These are the two main factors or the two main pillars that blockchain stands on. That it's transparent and there's not one real entity controlling everything. Now, it also helps reduce intermediaries. This happens in multiple ways, but since we're talking about banks here, with banks especially, there is no need for me to transfer funds to a bank first and for that bank to then send you money. It can all happen in one go. Peer-to-peer lending, peer-to-peer transactions, all of this is possible just with the help of blockchain. There's also more security and trust in the system. There are scams which occur because of the blockchain, but those could be for many different factors. One, they could have been due to the fact that quantitative analysis was not done. People didn't really know who the founders were, what their background was, what have they done in the past. Or they could just be, pure luck. You have so many smart contracts being written, and then it turns out there's one loophole which nobody thought about. Regardless, because despite these shortcomings that they have, it still is a method which grants you a higher level of security and trust. Coming to cryptocurrencies. So I'm using the word cryptocurrencies here pretty loosely. We can also talk about stable coins here in the same manner, because stable coins are probably a better stepping stone for the everyday person. So while people like you and me who've been part of the blockchain world for so long, we're probably okay with using cryptocurrencies, stable coins also have their own role to play in this entire ecosystem. Stable coins can be of multiple types. They can be backed by fiat. They can be backed by collateral, they can be backed by another blockchain cryptocurrency, or they can just be backed by, they can just be an algo stablecoin. They can be backed by smart contracts itself. So there are multiple types of cryptocurrencies, and all of them have certain advantages. Faster transactions, lower fees. Try sending some amount of money from one country to another. And especially if it's like a tier 2, tier 3 city. In Japan, for example, your bank will probably have to go through at least 2 different intermediaries, and they will all charge fees on that transaction. But when it comes to blockchain, this, or cryptocurrencies especially, this eliminates all of it. You can just directly send it, it's much faster, and because of the fact there's just one person in the middle, or no people in the middle, it's much cheaper as well. There are challenges. Volatility. So this is something which cryptocurrencies have been dealing with for a very long period of time. You have so many commodity classes, you have so many asset classes. You have your Forex, you have your stocks, you have your bonds, but the highest volatility that you find is probably in crypto. Now this has died down to a certain level ever since institutions have been coming in over the past 6 months. What institutions do is institutions probably hold your funds for a much longer period of time than retailers like you and me. What that leads to is a more stable price system. So even in this particular bull run, when we've had a lack of retail participation, if you just do a simple Google search or just a simple Google trends of how much is Bitcoin trending or cryptocurrency trending, it's not that high. Then why is the reason Bitcoin is near its all-time high again? It's because institutions are coming in and they're putting in their money. So here are some of the lessons from traditional finance that blockchain should implement. Regulatory compliance. Regulatory compliance is an issue across the entire world right now. So initially, those of us in the Web3 space, we had this utopian idea that we would all come together in like one summit, one conference, and create one set of rules that govern the way crypto works. But what we've realized recently is that's just not the way things are moving forward. Europe is going forward with MiCA rules, America is doing something else entirely, and countries like Dubai, which are really crypto forward, have different regulations entirely. So what happens exactly when we do cross-border payments? Whose jurisdiction are we under? Who is the one regulating all of this? So this is something which we can learn from banks. Despite the fact that they're slow and probably inefficient, they still have figured this out. They have the network effect with them. They have tons of assets with them. They have huge number of employees all over the world, and this just helps them be far more compliant. Now, when it comes to risk management, I'd mentioned stablecoins earlier. Amongst all the stablecoins that we know, we've seen crashes happen. We've seen Terra Luna happen, where something was pegged to USDT, and all of a sudden, it was just pulled. And people lost their hard-earned money on a coin which they didn't want to invest in. That wasn't something you were keeping to make more money. It was a stable coin. So here's where risk management is really important. Even most stable coins are backed by something. Who exactly is checking? Or are we sure that they have a 1:1 ratio of whatever asset they're promising? Banks do have this figured out to a certain extent. At least there are rules in place. Most banks around the world have to keep at least 15% of the deposits in cash with them at all times. Fraud prevention. Now, fraud prevention is again something in which traditional banks are doing a far better job. They have FATF regulations, so you know there's no fraud happening. They have these various lists that they put entire countries and institutions under. But when it comes to crypto, there's nothing of that sort. Even when it comes to something as simple as credit card fraud. Even in that small example, banks can figure out, using AI, using tech, that, okay, this might be something that this one person did not buy. So they might just send you a message or ask you a question. Was this you? These aren't technologies that are revolutionary or mind-boggling. They exist in the world right now. It's just that most blockchain firms, despite us believing that we are at the forefront of evolution, we are still lagging behind in quite a few significant areas. Even something as similar as customer service. Most centralized exchanges right now, which are probably the best when it comes to customer service, they still don't have live agents. You're probably still talking to a bot. There still is no real ticket. The resolution times are much higher than what banks take. So strengthening the blockchain with traditional methods. Stronger regulatory frameworks. So we have a few cities and we have the world coming together a little bit now. You have Hong Kong, which had been closed off to crypto for years and years, which now is launching Bitcoin ETFs. They are launching Ethereum ETFs. They are bringing regulations. When you have summits in Hong Kong now, you have government officials present over there, so you can talk to them and interact with them. It's a similar thing in Dubai. So if companies like ours combine themselves or go hand in hand with traditional firms or traditional banks, it might just be a win-win situation for all of us. So we discussed about the fraud detection systems, be it simple AI or be it FATF regulations. The risk management, again, so many coins, so many stable coins offer and guarantee that we have more than 100% of what we're offering in reserve, which is why you can launch something like an Ethereum stablecoin, like a DIR or DAI. But still, it still needs a lot of work to be done. Enhanced customer verification process. Why doesn't every single crypto firm or blockchain firm have KYC, KYB, and KYT? You have multiple startups, you have multiple established companies, which can all just be contacted and then onboarded pretty quickly. Maybe it's the fact that we aren't at it strongly or we don't consider it to be a priority. Insurance and reserve funds are another example of the same. While banks have access to insurance, crypto firms often get a much higher premium, or in most cases, none at all. Now, navigating regulatory landscapes. The biggest issue in this case here is varying global standards. We've had so many countries which come out with a particular rule and regulation, and then they roll it back 6 months later. They have one particular framework now, 6 months later, it changes completely. This really causes a lot of friction between companies which want to do things the right way and want to be compliant, as well as with the governments. We are seeing some changes now with multiple countries around the world having their own different things. Europe now has MICA, India now has FIU, and each and every different country is coming up with their own systems in place. Dubai, of course, has VARA. There is still a lack of clarity amongst most people around the world or most governments, and most of them are holding on to this aspect that we will just wait and watch. We will see how this entire ecosystem expands, the way it moves, and then be reactive rather than proactive in doing something about it. In this case, the onus falls on us, all of us in the Web3 space, to understand their concerns and address them directly. AML and CFT, again, extremely simple. Anti-money laundering acts and CFTs, which are counter-financing terrorism. So these are two simple measures that could be implemented within crypto, and the entire stain of us being a scam or this entire system just being a Ponzi scheme would go away pretty quickly. So I would just want to point out a few examples of successful integrations where these two worlds, which seem to be enemies, have actually worked together and benefited. One, digital identity verification systems. There's a major European bank called Santander. You probably see its holdings and sponsorships everywhere. And they've integrated blockchain tech into their own systems, whereby which all the transactions are verified, the IDs and everything is verified through blockchain tech. When it comes to enhanced loan disbursement, for example, as we know in the world of loans, micro loans are probably the toughest to monitor because there are a small number of loans which you give out to multiple people. And guess what? Alipay in China is using blockchain tech to do this exact same thing. So they can track everything efficiently and know exactly what's happening. When it comes to cross-border payments, it's a similar story. You have Standard Chartered, you have HSBC, and you have Deutsche Bank, which have made one collaborative effort where they're all working together as one to solve this entire issue. So these were some of the examples, and these are more ways in which we could all work together. Smart contracts. Smart contracts could be brought into traditional finance as well, where everything is recorded and operates based on an algorithm, instead of somebody having to physically verify each and every time whether your payment was made on time or no. DeFi platforms. So decentralized financial platforms are extremely crucial, mainly because of the fact that there is no intermediary. So you can just directly lend or borrow without having anybody else in the picture. So here at Xolo, we do have changes that we would like to make. In our roadmap for the future, by the Q4 of this year, we would like to turn our centralized exchange into a hybrid DEX. What that does is, you can just connect your wallets, your MetaMask, your Trust wallets, your ledgers to the centralized exchange, use the liquidity and get out without ever giving custody of funds to the centralized exchange. So measures like these are not the easiest to implement, but they can be done. And the future lies right here. Even when it comes to tokenization of assets, I think the word of the year and of this entire expo so far has been RWAs, real world asset tokenizations. not just wines, but entire mines can be bought at a fraction of a cost. Whether you want to own a luxury item, whether you want to own a piece of art, they're all possible through RWAs. And RWAs could be a great tool of bringing more and more people into this entire ecosystem. When it comes to cybersecurity measures, we have various cryptographic measures now available, which could really help impact and improve the entire security of the blockchain. But so far, we are seeing various stumbling blocks on the same. So this is how we can change the entire world of finance. We can have more blockchain adoption, more integration in everything that you do. We're all gathered here in Dubai, and I'm sure many of you flew in here. At the gates of Dubai, when you walk in and you scan your passport or your ID, that's using blockchain tech. That's a very simple, clear example of how blockchain and the Web3 world is all around you, and yet most of us barely even notice it. Clearer regulations, advanced security measures, and global inclusion. These are the steps that we're all working towards. So unfortunately, my time's up. But thank you guys so much. I hope we can build a world where both of these spheres intersect together completely, and we can build a secure, inclusive, more efficient and transparent financial future for all of us. Thank you for your time.